All right, let's move on here. Friday will mark the one-year anniversary of the flash crash, the violent intraday sell-off that saw the Dow plunge about 900 points in a matter of minutes. Since then, the SEC has put circuit breakers on all the stocks in the S&P 500, but is that enough to protect us from another sudden sell-off? We are joined now by Joe Saluzzi, the co-founder of Themis Trading, who has been very outspoken on the dangers of too much volatility as well as high-frequency trading. Joe, great to see you once again.
Nice to see you.
Interesting because Marianne Shapiro came out today and said basically that a flash crash cannot be prevented again. It could happen once again. So where are we in relationship to where we were a year ago?
They've done a few things. You know, they've put in some circuit breakers, single stock circuit breakers. They're trying to do a limit up, down, more like the futures markets do. But essentially, Mary Shapiro's right. A flash crash could happen at any moment, any day. Now, you have 10% single stock circuit breakers on only the Russell 1000 stocks, by the way. So you can still have these single stock crashes before they do the next limit up, downs. But that could happen. The problem with May 6th of last year, which most people still don't want to recognize, is that it was the severity of the drop and the quickness of the drop. We dropped in 15 minutes. We were down 10%. That's what could happen tomorrow. And that's where investor confidence is getting shattered. And the way to fix that is not with band-aids like single stock circuit breakers and a few, removal of stub quotes. Big deal. The way to fix it is to address the real root cause of the problem, and that's the market structure. That's the fragmented markets. That's the internalizers. That's the constant cancellations, the constant phantom liquidity that you see out there. That's not real. That's what you got to get to, and they don't have really the stomach to do that right now.
So what you're saying is, if we were 10 years ago and back trading stocks on the New York Stock Exchange with folks like Stevie Grasso,
right,
that could say, you know what, there's something odd here, let's take a pause.
That's right.
None of this would be happening.
No, you wouldn't have had a May 6th if the exchange model was still in place. However, you still had a 1987 situation, right?
Much different, though.
Much
over
different.
A much longer period of time.
That's right.
And in somewhat a much more orderly fashion than what we saw a year ago.
We see daily flash crashes, okay? Every day, this week, there was one with 50 stocks. Last week, there was one with 84 stocks. There was a stock that we talked about, Jazz Pharmaceutical. It went down $10 in 2 minutes. Okay, that's what we're talking about. How does that happen? You know, by putting in a single stock circuit breaker, that's not going to help that. I need to know, why is a stock dropping? Where is that liquidity disappearing to? Basically, the bottom line is there's no obligations for market makers anymore. They have benefits of co-location, benefits of market data feeds, but they have no obligations to stand there. So why are they going to stand there when times get tough? And they're going to walk. Okay, so until you address the problem of why won't market makers stand there, how do I incent them really to stand there, then you're still going to have these issues. A flash crash will happen again, and probably next time it'll be a lot worse.
Joe Saluzzi, thanks for coming by. I appreciate it. Joe Saluzzi of Themis Trading. All right, coming up next.